Anthony Landahl joining us from Equilibria Finance. Anthony, good to see you.
Great to be here.
So we had, CoreLogic came out with numbers yesterday showing that there's sort of a deceleration in those price falls, if you like, across the country. I mean, interestingly, Sydney actually going up marginally in that past month. Does that come as a surprise? I mean, there's some regarding perhaps that this is a bottom, others saying, no, we're in the eye of the storm, there's more to come.
Yeah, there's a little bit of mixed data. I think, as you say, the rate of growth, the slump is decelerating, if you like. And that came through in the latest data. And as you said, Sydney actually grew by 0.3%. But I think it's been buffered a little bit by low stock, and auction clearance rates are actually up a little bit. So I think that might be a little bit of buffering, potentially a little bit of further pain in terms of the housing market falling. Since August 2022, that was the peak. It dropped about 1.7%. It is starting to normalise a little bit in terms of the rate of decline. As I say, that's been buffered by low stock. We're not seeing a lot of new stock come on the market, but auction clearance rates, interestingly, have increased relative to the stock. So I think that might be buffering some of the decline that we've seen. However, the trend is there that the rate of decline has been slowing since August last year, which is a good sign.
Those dynamics, would that be normal in such a market where you are going to get, the stock is going to dry up simply because vendors are reluctant to sell if they're seeing those prices fall?
That's right. There's a lot of vendors sitting on their hands. Some interesting data we've been looking at is flows of credit, which gives a bit of insight into what's actually happening out there. We've seen credit flows for investors and owner-occupiers drop about 30% over the last 12 months. First home buyers has dropped about 35% in terms of credit flows, and construction funding's dropped 20%. So across the market, we're seeing a big drop in flow of credit to potential new buyers, and that, I guess, is part of what's flowing through across into the market. But yeah, a lot of people that might have been looking to sell their property are sitting on their hands waiting to see when the downturn might end.
So lending becoming more competitive, you're seeing some deals at the moment as banks try and get ahead of the rest of the market. Is that likely to stimulate credit growth, do you think?
That's stimulating a lot of activity for existing mortgage holders.
Right.
That's where we're seeing a lot of the activity where providers are either trying to retain their existing clients with offers, or existing mortgage holders that might have been on a higher rate, they're coming off a fixed rate, they're out there hunting for the best bargain. And a lot of providers are offering new business rates better than existing rates for mortgage holders, and there's a lot of providers offering some incentives with cashback. So there's a lot going on in the market for in terms of the refinancing market, and a lot of the providers chasing those refinances with the fixed rates coming off. But also people have been in loans that might have been a high loan to value ratio when they got the loan that are now out of market. So there's a lot of activity around the refinancing rather than the new business credit flows. I think people are just recalibrating, waiting to see how high those rates go before they look at getting back in the market. So
that is both in terms of the lack of new customers, both for residential property loans but also in business loans as well, is it?
Yeah, well, business loans, interesting. I had a look at a little bit of data around business lending. Business lending's shifted from investment in capital growth to cash flow. They're looking at funding their existing debt. They're looking at funding their operations. So we've been.
So is that just to make ends meet?
That's to make ends meet. At the moment, there's inflationary pressures, there's supply chain issues, increasing costs of running business, and there's also increased cost of their debt. So we're looking at more cash flow, short-term cash flow funding to fund that. But businesses we're finding are generally in pretty good health. They've got pretty strong balance sheets. They're just getting through some short-term cash flow funding issues.
So Anthony, what sense are you getting then in terms of likely credit growth going forward, given that the prospect is that the Reserve Bank's likely lift rates at least another 2 times, maybe, let's say 50 basis points if we factor in the next 2 rises, maybe even more. What's that going to do to credit growth?
I think the credit growth trend has been dropping. As I said, around 30% over the last 12 months. December was another 4%. And I think we're going to continue to see that decline in new credit growth just while these rates are going up, and also while the cost of living pressures are starting to bite people as well on a lot of other fronts separate to just their mortgage. I think existing mortgage holders are facing some of their own challenges with these increase, particularly people who bought in the market high, rates were low, housing prices were growing. They're struggling to actually change providers because how they're being assessed doesn't now meet the criteria. So there are situations where existing mortgage holders are actually unable to move to a better deal for themselves.
Yeah, well, maybe not encouraged by their brokers either, because what if you do that within the first, 12 or 18 months, there's clawback from their point of view, isn't it? They lose their...
Yeah, there is a rule which essentially just stops people churning clients from one provider to another. But at the end of the day, if it's in the best interest of the client to find another provider, then obviously that's the right choice for a decision for the clients.
So, I mean, I see you refer to a potential of a mortgage prisoner, if you like, something of a debt trap that people find themselves in.
Yeah, that's what happens. Essentially, someone is now unable to move to a better rate because the way the banks are assessing it means that they're saying, look, you don't service this loan. I think that's got to be looked at either by the regulator or the providers to bring in some other factors for those people with a good credit history who haven't missed a repayment, to look at other criteria in assessing someone where you're putting them fundamentally in a better situation, but they don't meet a set of criteria that they're also assessing a first home buyer who's never had debt. So it's a problem that's going to become more problematical as rates go up. They get further away from the assessment rate of 3%, which we're already above.
So, Anthony, what's going on with the investor perhaps that's been sitting on the sidelines and watching this all unfold? At what point would they be pulling the trigger and say, yeah, now's a good time to get back in, be it either in residential or commercial property? Yeah,
I spoke a little while ago about 2023 shaping up well for the investor, but so far they've still been a little bit spooked. I think the rate of decline in the housing market, as well as the rapidity of the interest rate rises, has still seen investors sitting on the sidelines a little bit. I think with investors, those seasoned investors, if you like, for want of a better term, are starting to come back in the market, but they're not looking particularly for a bargain in any sort of area. A bad investment's always going to be a bad investment in one sense. What they're looking for is those markets where the fundamentals still stack up, the long-term fundamentals of the yield and the capital growth still make sense. They might be looking at markets where it's either bottomed out or it's starting to actually improve, and then they're going to capture that capital growth as it continues to improve. But fundamentally, investors have still been a little bit spooked. They are still sitting on the sidelines, but some investors, those seasoned investors, are coming back in. They're not so much looking for the bargains, they're looking for those areas that haven't captured the growth yet. So they might have bottomed out, they might be starting to move, and they're looking for those areas to capture that growth over the next few years.
Yeah, because I mean, some of those yields are looking pretty attractive, aren't they?
Well, in terms of rental yields, they're as strong as they've been for 30 years. Vacancy rates are down below 1% in some of the capital cities, some of the regional areas similarly. So from a cash flow perspective, investment is attractive. I think they're still a little bit spooked about how far the market might drop and how many more rate rises we've got on the horizon. But the rental market's as tight as it's ever been. And obviously with the borders opening up, students coming back in, it's only going to get tighter from a rental perspective.
Anthony, thanks for joining us from Equilibria Finance.
No worries at all.